We are in Oregon, and so Oregon is the first state to roll out the regulated administration of psilocybin. And so there's some varying businesses in that pipeline. Uh, and and I know that sometimes businesses not necessarily has some baggage, and we don't necessarily like that word, but for the fact of the matter is, if you're not an employee, you're a business owner. And so that's one of the things that I'm going to go over is what's the difference between being a business owner or an independent contractor and being an employee? So what's the difference? And if you happen to be a service center or you're employing facilitation, like what's the difference between being an employee and being an independent contractor, being a business owner, or being self-employed? Those are, besides being an employee, they're synonymous. Um, we, and then I want to go over what are some of the tax ramifications from being an independent contractor? What is your default entity? If you are an independent contractor, if you're not an employee or an independent contractor, you are self-employed. And what does that mean to you from a tax perspective? And it's significant. So I want to talk about that. And then I want to talk about the entities. Like, what is the best entity structure for a self-employed person that is providing services in this industry? I want to talk about that, and some of the tax benefits of certain entities over others. And then, if we have time, I want to talk about whether or not you're trafficking in this industry. If you are touching the medicine, if you're not touching the medicine, are you trafficking if you're not touching the medicine? It's a good question. Sometimes people are being told that they are trafficking, and that's something that we can discuss. Finally, one thing that has come up quite a bit is how are the facilitators getting paid? How are the service centers paying the facilitators, or are the facilitators paying the service centers? That's something I definitely want to discuss. So I'm just going to jump right in. I don't see anybody else in the waiting room, so periodically I'll let people in. But first of all, let's start with who is an independent contractor versus what is the difference between an employee versus an independent contractor? Well, here in the state of Oregon, they have more rigorous requirements than they do federally. And there's 5 of them, really. And the main ones so this is for the employer. So if the employer is trying to decide whether or not a person is an employee or can they pay them as an independent contractor, there's a handful of factors. The first one is, are you dictating their time, or can they choose their own time? That's number one. If you're an independent contractor, you choose your own time. Number 2, are you training them to do their job, or do they come skilled? That's number 2. If they are already trained and they know how to do their job, they can be considered an independent contractor. If you're training them, then they're solidly an employee there. Do they have the ability to look for additional work? Meaning, can they provide services for other businesses, or do you have an agreement with them that they will not look for other work, that they're going to work exclusively for you? If they're working exclusively for you, they border on being an employee. Do they have a business license and insurance and maybe have filed with the Secretary of State? That is another stipulation. Like if they have an LLC, say, and they understand that they're self-employed, then they can be considered to be an independent contractor. So now the state of Oregon, and I suspect there are many states similar to it, they do have a pretty rigorous employment policy, though. So if there's any one of those isn't in effect, then the independent contractor could potentially go out and file for unemployment, and then the employment department will come back and be like, "Hey, this person says they should be getting unemployment," and you're like, "Well, they should have been an employee," and then or an independent contractor, there wasn't unemployment, and then the employment department will come audit you and make you pay payroll. So that's like the conversation that I have with business owners. But you as facilitators, you as service providers, that gives you a little bit of an understanding of when you are educating your customers, because as a facilitator, the service centers are your customers, you can be sure that they are protected in that you are solidly an independent contractor. So I wanted to have that conversation with you so that the service center providers understand what the difference between employee and independent contractor is, and then what you as a facilitator or service provider understand makes you an independent contractor. So if you, when you are an independent contractor, you're essentially self-employed. You are now a business owner. And what does that mean for you from a tax perspective? Number one is you're responsible for your own taxes. So when you are an employee, the employer will withhold money from your paycheck in order to submit to the taxing authorities, and money gets paid in on your behalf so that you don't actually have to worry about it too much. It's being taken care of. And so that's kind of one of the nice things about being an employee, being versus an independent contractor, is the taxes are, for the most part, taken care of. There are calculations in the payroll software that will estimate or total income at the end of the year. And when you file your tax returns, you might get a refund if you're lucky. With being self-employed, that is far from the truth. And in fact, if you don't take into consideration taxes at the end of the year and you file a tax return, oftentimes you will be blindsided by taxes. And it often is a lot more than you would anticipate, because self-employed people have what's called self-employment tax. And self-employment tax is 15.3% of your net business income. So net business income is your gross income minus your expenses for your business. So your mileage to and from the service center or wherever you're working, your office expenses, including your computer and your printer and your internet and your telephone and all that. You can write all that off. Your business license and your insurance, those are all things that you as a service provider can write off. But whatever your net bottom line is, whatever you are benefiting from personally, that is likely to be taxed. And so even if you make under $24,000, say, which is barely above poverty level, if you're netting $24,000 and you're in the state of Oregon and you have no dependents and you're not married, so this is just an example, you will probably pay about $6,000 in taxes at the end of the year, which I always find to be completely outrageous, because you're only making $2,000 a month, and now you're getting taxed $500 a month, and that takes you solidly just above the poverty level and puts you solidly below the poverty level. So you need to be prepared for that. Even if you're not making much money, you can potentially pay a lot in tax as a self-employed person. So you need to be prepared for that. And you need to be putting at least 25% of every payment you get away to pay for those taxes, to be ready to pay those taxes at the end of the year. So what is this 15.3%? That's self-employment tax. That essentially is the tax that the Social Security and Medicare tax that you're not having paid on behalf of you as an employee, but you are now responsible as a self-employed person. So again, the employer having you as an employee is not only withholding half of the Social Security and Medicare tax from your payroll, they're also matching that payroll. So when they pay you $20 an hour, they're actually paying another $3 an hour on your behalf to the unemployment department, the IRS, or Social Security and Medicare tax. So that's what's called employer taxes, and they pay employer taxes on your income as an employee. As an independent contractor, that's not happening. So you're responsible for your Social Security and Medicare tax, and you likely are not, you will likely not have the ability to get unemployment. So that's another thing you need to be aware of, that only in special circumstances can a self-employed person go to the employment department and get unemployment. That happened during COVID. They had a special program where the federal government granted the state unemployment in order to cover unemployed or independent contractors or self-employed people and get them like PPP and unemployment and those kinds of things. That's not always the case. I don't know if there's a program now, but I don't think there is right now. So you as a sole proprietorship will not be able to get unemployment. So you need to be aware of that. So that is what it, that's the caveat to being those are the caveats to being when you're responsible for your own taxes, you can't get unemployment. So those are the things that you really need to know. Okay. Business entity. What is the business entity you should set up for yourself? I always advocate for an LLC. You can go to, again, where I'm talking to Oregon people, and Oregon is the first regulated psychedelic industry. And so I'm very Oregon specific, even though you may be out of Oregon when you listen to this. So I recommend that with your state, you get an LLC. Some of the fees are might make it cost prohibitive. In California, for example, an LLC has to pay $800 every year, regardless whether they make money or not. That's a pretty steep expense. Most other states don't have that big of a Secretary of State filing requirement. In Oregon, it's $100. So it makes a lot of sense for people in Oregon to get an LLC. And it's easy. You can get online. You go to the Oregon Secretary of State and you register a new business. And you want to make that business somewhat not specific to psychedelics or psilocybin so that you can get banking. So just be careful in terms of the name that you choose, and so that it doesn't smack of psychedelic services, which I am now hearing the banks are asking. So in the past, they do solidly ask if you're cannabis related, and now the banks are starting to ask, are you in psilocybin? And you will want to say no. I mean, you're going to want to get a regular bank account. So you're going to need to be like, I am a life coach. I think everybody on this who is watching this are now all life coaches. That's what I think that everybody should say that they are, life coaches. And you dabble in psychedelics as a means to help your customers and your clients. Unfortunately, that's the only way you're going to get out of potentially having to pay fees for psychedelic specific bank accounts. There is one, I think Citizens Bank right now out of Oregon. They are banking service centers. They will not allow money to be banked if it's for the purchase of the medicine, but they will bank for room fees and facilitation. But that comes with a cost. And in the cannabis industry, it's anywhere between $400, $500 to $1,000 a month to have a bank account. I don't know what Citizens Banks is charging, but I do know it's a couple $100 at least. And I suspect that those fees will go up as more and more people start to need a bank. And so it's something to consider when you're filing with the Secretary of State. Choose a name that is a consultant type of name. Maybe your name LLC or your name consulting LLC. You will also maybe want to do a business name search to make sure that the LLC that you're trying to file for is not taken. So you can do a business name search on the Secretary of State website to see if the business name is taken before you choose it. Now, If your name is in it, then it's likely not going to be taken, right? Then you can go to the IRS website. Oh, I'm going to go back. One more thing. The Secretary of State in Oregon will prompt you to get what's called the BIN number, business identification number. Don't get it. You don't need it with Oregon just yet, because the business identification number is a requirement for, well, you may need it if you're trying to get your facilitation license. They may require you to have one, but as soon as you get one with the Secretary of State, through the Secretary of State or through the Oregon Department of Revenue online, or they will start expecting you to file quarterly payroll reports. And it's a real pain, because they automatically start assuming that you should be doing payroll, and that is not the case. And so you will start getting notices that you need to file 0 quarterly reports. And I suggest that you do that, because what they'll do is all of a sudden you'll show up, you'll ignore them, and then you'll show up with a $6,000 bill from the Oregon Department of Revenue for not paying payroll. And then you're going to be like, what the hell? Like, I didn't know, what is this? And then you're going to call me, and then I'm going to have to tell you, I'm going to have to deal with it. So what I'm telling you to do is, if you don't have to have it, don't get a BIN number until you have to have it. And then it's just a quick application, you get it. But don't get it when they prompt you to have it. You don't need it, unless, of course, it's required for your license. But I don't know that for sure. So you got your LLC. You go onto the IRS.gov and you apply for an EIN number, and it's called, strangely, an employer identification number, even though you can get it and the IRS doesn't expect you to be, to be paying payroll. You can have it and you can never act on it. You just have it. You don't have to do anything with it. You're not going to get in trouble if you're not filing reports or anything like that. You can have it and you can forget it if you want to, but it's necessary for you to open a bank account to have both the LLC and the EIN number. And those are the two things that you need to open up a bank account for. And so that's the minimum filing requirement. Now, be careful when you're filing for the EIN number. Make sure that you go to a unsponsored page. You go to the IRS directly, and it's free of charge, and it's easy to do. And you don't need to pay anybody to do it for you. Both of the LLC and the EIN number are easy for you to do. So with those two things, you can get a business bank account and then get some sort of double entry accounting software, QuickBooks or Xero. You can, if the volume of transactions is low, just track things using Excel spreadsheet, but don't ignore your finances. Make sure that you are tracking that. If you are make sure that if you're receiving cash as payment, you put it in the bank account, and you only spend money out of that business bank account for business transactions. Do not use your personal bank account for business expenses. Get a business bank account and only use the business account for business expenses. You can borderline whether or not it's personal or business. Like, say you're going to go to a conference and you fly to Denver and you go skiing in Denver as well. You could use the business card. It's A-okay. Let your accountant sort out whether or not it's deductible or not. But if it's for business and that's the primary reason you went to Denver, then put it on the business card. Get a credit card and only use it for business. Don't use your personal bank account for business transactions, and don't use your business bank account for personal transactions. It's okay. It makes it a lot easier for us as bookkeepers to do your bookkeeping if we can just assume that all your transactions are business, versus having to go through and rummage through your personal bank accounts for business transactions. It's very difficult. So that would be step 3 in being a self-employed person. Of course, you're going to probably need insurance. I don't know if the service center is going to be able to cover you and the facilitation through their insurance. They may, and that's something that you're going to want to talk to them about. But I do know that there are a few insurance companies that are providing insurance, and unfortunately, it probably is at an unfair price because it's involved in a federally illegal business. All right. So, speaking of federally legal business, I do want to talk about how you can mitigate your taxes. Like, so one of the things that I said before is that you will be shocked at how much you will have to pay as a self-employed person for taxes. There are different business entities. So the LLC that I'm recommending you get is a legal entity. Okay, it is not a tax entity, a legal entity with the state that you're in. It's become highly popular. It wasn't as popular 20, 25 years ago. An LLC meant that you were a partnership, limited liability company or limited liability partnership. But now the LLC is the entity of choice for legal protection. And then the IRS has extended the opportunity to elect to be taxed as an entity other than a partnership. So your default entity as a single member at what they call a single member LLC is a sole proprietorship. And that means you don't really have to do anything. As soon as you get paid as an independent contractor, you're a sole proprietorship. And you're going to be subject to the self-employment tax. And you're going to need to make sure you put money away that will prepare you for the taxes that you're going to owe at the end of the year. Now, if I want to also back up a little bit, if you have kids and you're married and you have kids, or you're not married and you have kids, and they're under the age of 17, then you likely won't have as low of a threshold and owe as much as I told you in my first scenario, where I told you would owe like 25%, even if you're below the poverty level. If you're below the poverty level and you have kids, then you're going to get what's called earned income credit. And that's going to drastically offset those self-employment tax, and you may even get a refund. But the more money you make, the faster the earned income credit goes down, and the more money you make, the more tax you owe, and it goes really fast. So in 1 year, you might have gotten like a several $1,000 refund from EIC. And then the next year, you will pass that threshold. It's only like $40,000 or something like that. You'll pass that threshold. And then all of a sudden, you're going to owe a ton of taxes. So either way, you want to be prepared for owing taxes. And I recommend putting away 25% of your gross income at least. Okay. So especially if you're a sole proprietor, where you're going to be owing money on self-employment taxes. So if you're a partnership, the owners of the partnership also owe self-employment tax. So not only are you paying federal income tax, state income tax, you're also going to be paying self-employment tax. And that can be very expensive. It can get up to 40 to even 50% of your net business income for higher net worth people who are bringing in more money. It can get up to 50% with all the self-employment tax and whatnot. But as a low income facilitator to to 40, 50, 60,000 to 90,000, a sole proprietorship is very painful for the amount of money that you have to pay in taxes. There is another entity that I often recommend, and that is an S corporation. An S corporation is, you can be an LLC and you can be taxed as an S corporation. And the nice thing about the S corporation is that you don't pay self-employment tax on the net income anymore. So where you were paying 25% as a small business, you are now only paying 15% as a small business, or 10% as a small business. And that is a big relief to some people. So how it works though is you have to put yourself on payroll, but when you're at a reasonable amount of money, when you're not making very much money, when you're not making above the poverty level, you don't necessarily need to be concerned about paying a payroll. But when you are reaching the 30 to 40 to 50 to $60,000 a year net income, then you need to start thinking about paying yourself what's called a reasonable wage. And a reasonable wage is undefined right now for you guys, and you can just put yourself on a minimum wage. Okay, so you use QuickBooks Online, use Gusto, use a third-party payroll provider. You have them set it and forget it, minimum wage payroll. And then you also can take money out of your S corporation, your business, your LLC being taxed as an S corporation. You can take that money out of that, and it can be paid. It can be paid to you directly as a draw from your business, and you're going to pay. So therefore, you pay some employment taxes, some self-employment taxes on the payroll. You pay yourself through your payroll, and then you're going to have a little bit, and then the draws that you pay yourself are not subject to payroll taxes. They're not subject to self-employment tax. You're going to pay regular federal income tax. You're going to pay your state income tax. But other than that, you eliminate that 15.3%. Okay. And so that is a big boon for you. So say like you're making $60,000 a year, you pay $30,000 in wages, $30,000 in draws. You're going to pay the 15.3% on the $30,000, which is about $4,500, but you're not going to pay $4,500. But you're not going to pay the $4,500 on the other distribution, on the distributions. So whereas if you're a sole proprietorship, you would have paid a full $9,000 on that money. You would have paid a full $9,000 only and that's just for the self-employment tax. So that's a bigger conversation. I'll probably do another meeting just on that alone. Okay. I'm going to look at some of these questions that are coming through here and then pause for now. Right now, so as far as insurance companies, there are a few out there, but the one that I refer people to, I believe, actually, I think Ryan, I don't know, from Oath Insurance is who, let's see here. And then Ryan's saying, now this is not the same as insurance company, or am I wrong? I don't know. One service center that has a contractor model requires facilitators to collect payment for room rentals. Yes, I was gonna talk about that. How do you recommend labeling that as business expense come tax time? I've already set up an LLC. How do I set up an S corp? The S corp is set up with by filing what's called a Form 2553. And you definitely want to talk to an accountant about that. Maybe just do a quick consultation. It's not something that I would recommend you do on your own, just to make sure that you're staying in compliance and the tax returns are getting done properly. Most reasonably educated, experienced accountants will be able to adequately educate you on filing a election to be taxed as an S corporation. If they say, well, you have to set up an Inc., then they're way in the dark, and that a lot of times some of the attorneys that haven't gotten up to date will say that, well, you have to dissolve the LLC and then you have to file for an Inc., and that is totally not correct. You can be an LLC and all you have to do is file a 2553. And then you're now an S corporation. Unfortunately, you rarely will get the letter from the IRS saying we acknowledge you as an S corporation. You just need the accountant will just file the S corporation for you. It will either, when they electronically file, it'll either be accepted or it will be rejected. If it's rejected, then a new 2553 probably needs to be filed with a late election in order to get that tax return to be accepted and for you to be able to have your entity taxed as an S corporation when it was supposed to. So there we go. As far as Oath, I'm not sure if they are the ones doing facilitators for sure. Honestly, I'm not absolutely sure who, if they do insurance for facilitation, but I also have some other connections that I need to follow up with that could potentially provide that. Okay, so let's talk about like facilitators and getting paid and how facilitators should be getting paid and first of all, if you're not touching the medicine, there's a great argument for you that you're not trafficking. Some attorneys and accountants might be telling you, well, if you were in the same room with the medicine, then you're trafficking. Well, there is the MAPS court case precedents in the cannabis industry. CHAMPS, not MAPS, CHAMPS. I apologize. California is helping alleviate medical problems. And they were audited by they're a nonprofit organization providing medical services as well as providing cannabis. They got audited. They got their nonprofit status revoked, and then they got all of their deductions disallowed due to 280E. They went bankrupt, but they fought the good fight. They took it to tax court. And then the tax courts did judge in their favor and conclude that those expenses that were related to the services aspect of that business were deductible. Okay, so that's really good news for the psychedelic industry at large, because the service aspect of it is deductible. Now, we've got a little bit of, some of the stuff is kind of hangs us up a little bit in that in Oregon, we're not allowed to call it therapy or medical assistance or anything like that, but we can call it caregiving, right? We're doing caregiving. We are providing a service. We are not trafficking. You're not allowed to touch the medicine in Oregon in the regulated market. You don't touch the medicine. So even if you're not in the regulated market, if you're in the same room, it doesn't necessarily mean you're trafficking. So some attorneys will say, well, it's better to play it safe than sorry. So you may want to do what's called a C corporation. A C corporation pays its own taxes. You just get paid through the payroll system exclusively. And then if you get audited, and they screw up your program and they assess your business with a large tax bill, it stays in the corporation. You personally are protected. With an S corporation, that's not the same. It's a pass-through entity. So if the IRS comes through and says, well, we're going to audit you and we're going to disallow your expenses. Well, first of all, if all your expenses is your office expenses and your phone and, those kinds of things, then you don't have much to lose, right? So an S corporation works. So and that probably won't happen, and it's very defensible. It's very defensible that you're not trafficking. But if it were to happen, if the way you're getting paid is the client is paying you, the service center's client is paying you just for services, for caregiving services, for facilitation services, and your expenses are low because you're not paying room rent, okay, and you're definitely not collecting the money for the medicine, you're safe in that even if 280E were to apply, you wouldn't have to, there would be very little adjustments to your tax. So I highly recommend LLC being taxed as an S corp, where the service center has the client pay you directly. You don't pay the room rates, okay? You don't pay the room rates, and you're definitely not receiving the money for the medicine and paying for the medicine. That is the optimal way for facilitation for you, is to be paid separately by the client. That protects you. It allows you to mitigate your taxes. Okay. So the other way that I've been hearing the way people have been doing it is, the client will pay the service center, and then the service center will pay you. And as an independent contractor, again, it's the same kind of thing where all your expenses right now are just your basic admin, your office expenses, your cell phone, your computer, your business. Like, there's not a lot. So if the IRS were to come in and say, like, you're subject to 280E, you're like, okay, and then you're going to take a little bit of a tax hit. But the other way is you end up receiving the money for the facility. You are receiving the money for the facilitation, and then you pay the service center for the room. Then you are now on the hook for that room expense, and you pay. So you're receiving the money for the room. You're receiving the money for the facilitation, and then you then pay the service center for the room rent, which is an expense to you. And it's just called room rent. So there was a question about, like, well, how do I expense that? Well, it's just called room rent. You've got room facility income, which is the money that the client pays to you. And then the money goes out of your bank account to the service center for room rent. And that's how it gets booked. The problem with that, though, is that if the IRS comes in and decides that you are trafficking for whatever reason, and again, I think it's a really low percentage that will happen because these aren't medicine touching activities, but they could give you a hard time, and you don't want to pay an accountant to have to, like, go defend you in an audit, or worse, take it to tax court where you have to hire a tax attorney and battle it out with the IRS. But if it were to happen, you would have a good argument. Or they might just say, we're gonna disallow the room rent that you're paying, and that's no good. We don't like that, because that's a lot of money that all of a sudden you have to declare the rental income that you're receiving from the client for facilitation room, for the facility room, but you don't get to deduct what you paid out. So now all of a sudden you're paying a bunch of taxes on phantom income, and that's no fun, and we don't like that. And so that's why I'm saying, if you can avoid that model, that would be the best for you. All right, very good. So I can go on and on, but I'm going to go ahead and just open it for questions. If you just want to turn on your microphone and just ask any questions that you have, I'll do my best to answer those questions. So there is a question from Ryan here about, so the facilitator is collecting payment for room rentals. So he says, so I'm paying from my own business account to rent the room for the session. How would you recommend labeling that as a business expense come tax time? So that's what I'm telling you, that if you can get out of that relationship, that would be probably a good way of doing it. But really, it's just room income and then room expense. If you want to, you could potentially hide it. And if there's no markup on the room and it's just kind of a pass through, you could do like, this is technical, but you could do like room rent payable, and it goes what's called on a balance sheet. And it becomes a loan, like a debt. So you receive money from the client as a debt that is just passed through to the service center. But with that, there can't be any markup on that. You don't want to have any markup on it. So you receive the money for the room, and then you immediately pay the service center for that. And it bypasses being income altogether. So if you're in this sticky situation, then that's kind of probably what I would recommend. However, if they audit you and look at your bank statements and they see the room, they might be, well, that's income and that's expense. But you can say, like, no, I'm just collecting it on the service center's behalf. But it's really reducing the integrity in terms of your argument that you're not trafficking if you are helping the service center avoid paying taxes or avoid 280E, right? So, and they're going to have to pick that up as room rental on their tax returns anyway. So I don't understand the point, except for maybe banking purposes or something like that. Let's see, Evelyn. Okay, so you already have an LLC. You want to set up an S corp. We talked about that. 2553 is how you elect to be taxed as an S corporation. There is more to it. You probably want to spend a little bit of time talking to an accountant first. If we work from home, how much of our rent can we deduct as an office space? And then I'll answer that, but let me see what else you're saying. Also, to expand on Ryan's question, do we have to explicitly label everything, even if it's all neatly in the same business account? What exactly can we write off? So that's, again, like I was trying to tell you, like, if you're paying the rent on behalf of the client, you want to keep it off the income statement. So you don't want it to show up as income on your income statement, so you just pass that money through. You're just passing it through. You're not claiming that money. You're just doing the service center a favor and you're passing that money through. Okay. You're going to make your money on the facilitation. That's how you're going to make your money. But as far as home office, business use of home, that's a standard business deduction that you can use a simplified method. All you have to do is tell your accountant, I have 300 square feet of business use of home. And then I think it's like, I don't actually know how much it is, the standard rate. Let's see, Nathan's on here. Nathan, can you get me can you find out the standard rate for me and put it in the chat if you have time. But otherwise you do like this kind of proration type of thing. You're like, my house is, 1,500 square feet and I have a home office and that is, a 12 by 12, or it's, whatever, 240 square feet. So then what you do is you take 240, you divide it by 1,500, it gives you a percentage. And if you're paying $24,000 a year on, a year for rent, and your home office is approximately 10% of your square footage or 20% of your square footage, then you get to deduct 20% of 24,000. Okay. And then you can also deduct it you can take 20% against. So Nathan says it's $5 per square foot, capped at 300 feet. That's where I came with that 300. So you get $1,500 just standard if you have a 300 square foot exclusively used for business office space. So I, as an accountant, have to tell you exclusively used. I don't know a single person who doesn't have photos on their computer or uses their computer for other things other than business, but that's what the IRS says, and they could get persnickety on you if they wanted to and say, if that computer is used for anything but for business, then that whole deduction is disallowed. But I've never seen that happen. It's only people who are getting greedy with it, where they're like, 50% of all my business, 50% of my rent is deductible, and 50, I would just say, like, if you want to keep it simple, just do the square footage, do the $5 per square foot. It's about the same. But 20% of your home, if it's 20% of your home and you're using, and you're paying about 24,000, that's a lot more. That's more like $5,000. So sometimes it does pay to do the calculation. And so that's how that works. And it's a prorated thing. You take the percentage of your business, or you take the square footage of your exclusively used for business space, you divide it by the total square footage of your home, and then you multiply that against all of your housing. So, and it could be everything. It'd be like even your landscaper. You could write off a percentage of your landscaper if you have landscaping, or your home association dues, which are outrageous. Oftentimes you can multiply, you could take that percentage against the homeowner dues, your utilities, your rent. If you have like a mortgage, that's a little bit different because your interest actually gets to be calculated on like a itemized deduction too. So there's a little bit of tax acrobatics that has to be weighed as to whether or not the standard deduction the $5 per square feet is better, or if you're renting, then almost always prorating it is better. So that's the answer to the home office. And remember, there's mileage. So also another, for service providers like yourself or consultants, mileage is a big deduction. It's a little bit over 50 cents. It might even be 60 cents a mile now. I don't have it off the top of my head, but essentially, if you have a home office and you're driving to the service center every day for work, then you have to maintain a home office. That's the important thing. You can't not have a home office. You have to have a home office in order to deduct what they call commuting miles. So you're commuting from home to work. Now, ordinarily, commuting miles are not deductible, but if your home base, your business base is at your home, then you're essentially driving from work to a client, and that justifies a mileage deduction. And so I just kind of rounded down to 50%, 50 cents a mile. It's more. So if every day you live in Medford, Oregon, you drive to Ashland and it's 20 miles round trip, then it's about $10 a day deduction. So it's worth tracking your miles. Now, they expect you to keep a log where you're writing your odometer reading. You have your odometer reading, and you're like, okay, my odometer reading was this before I left Ashland, and now it's this. Okay, so that's ridiculous too. Like, nobody does that, but you can keep like a mileage IQ or an app or something that will do that calculation for you and drop it into an Excel spreadsheet. That's really nice. Or if you really only have one client, or you have two clients, it's pretty easy to back in. You just need to keep track of what days you drove to which location, and then you can calculate the mileage after the fact. I drove to Ashland 3 days a week, and I drove to Grants Pass 2 days a week, and total, I worked 8 months out of the year, or 10 months out of the year, 10 times 4 plus, I don't know. It's, sometimes there's 5 weeks in a month. Sometimes there's 4 weeks in a month. Most of the time there's 4 weeks in a month. You got to do the math, but that's the way but you definitely always want to have your beginning odometer reading at the beginning of the year and your odometer reading at the end of the year. That's the only way you're going to know how many miles total you drove. And that is another question that we as accountants will ask you, not just what was your business miles. We also ask you, what was your total mileage? And it has to make sense. If it doesn't make sense, then you've got a problem. But otherwise, my experience with audits, so I've represented many people in audit, and sometimes mileage comes up. And most of the time, if you have any reasonable records whatsoever, a calendar showing where you're supposed to be, and you say that, okay, maybe you go back and you're like, this is how many miles it was to this, for this day, and this is how many miles it was for this day. Something is better than nothing. And they'll even allow you to like recreate it in Excel. So they're actually very flexible with mileage. Oregon, on the other hand, is not. They'll just say like, hey, no mileage log, no deduction. And you don't get the deduction for Oregon. Right on. We're almost to the hour. Let's see here. Back to Evelyn's question. Do we have to explicitly label everything, even if it's all neatly in the same business account? What exactly can we write off? Okay. So that's a good question. If you have QuickBooks, then if you have QuickBooks, then it gives you a standard chart, what's called a standard chart of accounts. And the standard chart of accounts is going to give you ideas. But you guys are a service providers, facilitators or service providers. So you're going to have mileage, you're going to have home office, you're going to have office expenses, you're going to have insurance, you're going to have business license, you might have travel, you're going to have continuing education, you're going to have licensing for your license. Those are all things that are deductible. Anything that is for the purpose of generating revenue through your small business is deductible. And like I said before, if you travel for a conference, you do a little bit of personal on the side, as long as it wasn't actually meant for personal, it wasn't a personal trip that you added a little bit of business to, it was more of a business trip that you add a little bit of entertainment to or business, then you can be free to write off that hotel accommodations and travel. It just can't, it has to be within reason. You can't be egregious with it. You can't go book a trip to Hawaii, and then go meet with, somebody in the psychedelic industry, and just to say hi, and then go take a 2-week trip to Hawaii and sit on the beach for 2 weeks. You can't do that. A lot of people love to play games like this. It's just not worth it. Travel is a high risk, a red flag. If it's too high, they're going to audit you. And so don't risk it. If you go, say, to Denver to the MAPS conference and you ended up going skiing while you were there, that's different. That was, you went there for business and you threw on a couple of days to go skiing there. All right, guys. Well, I much appreciate it. Does anybody have any other questions? I know it's a lot to unpack. I'm gonna try to. There's a couple of things that we're doing in the business, because I recognize that in the psychedelics industry, just not in Oregon, most businesses, self-employed people, are actually in the business of providing services. It's a lot different than the cannabis industry, where that's more of a commodity and people are selling a commodity. There's a lot less money in the selling of the medicine than there is for service centers providing facility, a place for sessions and a place for facilitation. And then there's a whole host of facilitation, right? There's a whole host of facilitators. So the psychedelics industry, I have determined, is much more of a service business. And so we are I'm gonna do like maybe a 5-webinar education series, where the things that I touched on today, which I feel like I got most of it in, I'm gonna do some smaller videos and blast that out to people. We're gonna try to okay. So Evelyn, you asked about how much does it charge for accounting. That is a good question. My firm, our firm, Calyx, is definitely a niche industry, a niche business that specializes in cannabis industry, specializes in psychedelics industry, because it's a plant touching a trafficking, because it's a trafficking enterprise. And there's a lot of nuances there. There's a lot of people who are working in the gray market that want to be on the grid, that want tax returns. There's a lot of people who are providing ancillary services like facilitators and those kinds of things. We typically make our money on the trafficking businesses because we mitigate 280E and we have creative ways, and it's a high risk and very sensitive thing to be doing. And therefore we're highly we're highly responsive and highly accurate. And we do everything that can to cross our I's or dot our I's and cross our T's. And so therefore we are more expensive than if you were to go to an average practitioner, general practitioner, an average accountant who will likely be able to do it for less than us. However, some of you work with us already. I believe I let you know this, but we do have a small team of people in the Philippines who work in the Philippines. They're highly trained, highly professional CPAs, and they're awesome. And that allows us to be able to, do some work at a lower cost. Most of the work that we do is my time, which is the premium, and my tax managers, onshore tax managers, and other CPAs onshore who we have to pay competitive U.S. wages. So therefore we charge more. But for you, we're going to come up with a plan to try to standardize some sort of tax and bookkeeping, perhaps payroll offering to you to circumvent needing to work directly with me and my tax managers, and instead have my offshore team provide the tax compliance services for a lower cost. We still pay them very well, so it's not going to be like super inexpensive, but it will be competitive, at least to other businesses. And then I'm going to probably continue to do webinars similar to this, where once a month I invite everybody who has questions to come to a meeting similar to this, to ask all their burning questions, and then as far as like tax reporting and tax compliance goes, that's going to be something that I give to, say, a client manager who's located in the Philippines. They are amazing. They speak excellent English, and they know, they're very, very experienced. So that's something that I'm thinking about. And the cost, I don't know what the cost is going to be just yet, but it will be probably, starting at a couple of $1,000s to get the services, especially with the S corporation election and to prepare an S corp. And then it might be a little bit more for bookkeeping, for payroll. But the big thing is that you're not a trafficking business, so we don't have to go through the same tax acrobatics as we do with service centers and other trafficking businesses. So that's what I've got for you. If you need, if say you opt into this plan that I'm talking about, where we're definitely offshoring a lot of the work, then what we might do is have, if you need to communicate with us, there would be additional tiered options to work with a onshore tax manager, including myself. But of course it would be more. So that's how that works. All right. I'm going to send out a recording to everybody here. I much appreciate it. Appreciate everybody who attended, and thank you very much.